European officials are attempting to project calm in public while quietly preparing for scenarios they fear could spiral out of control. Beneath carefully worded statements and optimistic forecasts, a far more troubling reality is taking shape. From late 2024 into early 2025, Europe is entering a synchronized sovereign debt crisis that in many ways resembles the 2010-2012 Eurozone meltdown, but with one critical difference. This time, the crisis is no longer confined to peripheral economies. It now directly threatens the core of the European project itself. During the last major crisis, countries such as Greece, Ireland, and Portugal were the epicenter of instability. Today, those nations are no longer the main concern. Instead, large and systemically important economies such as France and Italy are running deficits far beyond what the Eurosystem was designed to tolerate. France is posting deficits of roughly 5 to 6% of GDP, while carrying a debt load of around 112% of GDP. Italy continues to struggle with deficits near 4 to 5% and a debt ratio of 145%. Even countries long viewed as fiscally disciplined, such as Belgium, Austria, and the Netherlands, are seeing deficits and debt levels that would have been politically unacceptable just a decade ago. This is not a collection of isolated problems that can be solved with a targeted bailout or two. It is a systemic debt sustainability challenge spanning countries that together account for well over 60% of Eurozone GDP. That scale matters enormously. The euro system was never designed to absorb simultaneous fiscal stress across its largest members. If crisis management fails, the consequences could range from severe austerity and debt restructuring to a fundamental rupture of the euro itself. The raw numbers alone explain why officials are alarmed. European government debt has risen dramatically over the past decade and a half. In 2010, total public debt across the Eurozone stood at roughly $9 to $10 trillion. By late 2024, that figure has climbed to approximately 14 to 15 trillion, equivalent to around 90 to 95% of Eurozone GDP on average. This average hides enormous disparities. Germany remains near 66–68% of GDP, while Greece exceeds 160%, and Italy sits well above 140%. France, once considered a pillar of stability, is now firmly in triple-digit territory. During the 2010-2012 crisis, European institutions responded by creating unprecedented rescue mechanisms. The European Central Bank stepped in with massive bond-buying programs, while political leaders established the European Financial Stability Facility and later the European Stability Mechanism. Together, these tools provided hundreds of billions of euros in emergency lending and market support, ultimately preventing sovereign defaults and a euro collapse. By late 2024, however, these same mechanisms are far less effective. The ESM has around $500 billion in theoretical lending capacity, which sounds substantial until one considers the size of the countries now at risk. France alone has a roughly $3 trillion economy, and Italy's economy exceeds $2 trillion. Supporting both at once would quickly exhaust available resources. At the same time, the ECB's ability to act is constrained in ways it was not a decade ago. Political opposition in creditor countries has hardened, and legal challenges, particularly in Germany, have narrowed the scope of what is considered acceptable monetary intervention. Large-scale bond purchases are increasingly framed as illegal monetary financing of government deficits, rather than legitimate crisis management. These constraints matter because financial markets know that central bank backstops only work when they are credible and unlimited. If conditions deteriorate further through 2025 and into 2026, Europe could face a scenario in which bond yields spike, spreads widen sharply, and governments struggle to refinance maturing debt. In such a situation, European authorities may lack both the financial firepower and the political consensus needed to respond decisively. The resulting choices would be grim. Governments could impose harsh austerity that risks recession and social unrest, restructure debt in ways that damage banks and pension systems, or, in an extreme case, consider exiting the euro to regain monetary sovereignty. Any of these outcomes would shake the foundations of European integration and could easily spill over into a global financial crisis. France illustrates the danger more clearly than any other country. As the Eurozone's second-largest economy, France has long been regarded as a core member alongside Germany. That perception is now under strain. In 2024, France's deficit reached roughly 5 to 6% of GDP, equivalent to $180 billion in annual overspending. This is roughly double the European Union's nominal 3% deficit limit and highly problematic for a country already carrying debt exceeding 110% of GDP. In absolute terms, French government debt stands at approximately $3.2 and $3.3 trillion. The burden of servicing that debt has grown rapidly. When interest rates hovered near zero, France could roll over its obligations at minimal cost. Since rates rose to around 3 to 4% between 2022 and 2024, annual interest expenses have surged to $50–60 billion. That figure consumes an ever larger share of government revenue and forces policymakers to choose between cutting spending, raising taxes, or tolerating even larger deficits. Markets have taken notice. French bond yields have widened significantly relative to German bunds, with 10-year spreads reaching 100 to 150 basis points, far above historical norms. Each additional basis point translates into billions in higher borrowing costs over time. Political instability has compounded these fiscal pressures. Snap elections in mid-2024 produced a fragmented parliament, leaving President Emmanuel Macron struggling to form stable governing coalitions or pass a credible 2025 budget. Without a functioning majority, meaningful fiscal consolidation has become nearly impossible. Credit rating agencies have responded by downgrading France's outlook or placing it on negative watch. A loss of France's high-grade rating could trigger forced selling by institutional investors, potentially pushing the country into a full-blown bond market crisis. Italy's situation is even more structurally fragile. With debt between 140% and 145% of GDP, Italy has long been vulnerable to shifts in market sentiment. Government debt totals roughly $2.9–3.0 trillion, and annual interest costs range from $80–90 billion, consuming around 4 to 5% of GDP. Despite repeated promises of fiscal discipline, Italy continues to run deficits near 4 to 5% of GDP, and its structural deficit, adjusted for the economic cycle, remains elevated at roughly 3 to 4%. This indicates that even in normal times, spending consistently exceeds revenue. Italian bond yields have traded between 3.5% and 4.5% through much of 2024 and early 2025, compared to German yields closer to 2 to 22.5%. The resulting spreads of 150 to 200 basis points have been volatile, widening sharply during periods of political tension or weak economic data. Growth remains anemic, at around 0.5 to 1% annually, far below what would be needed to stabilize or reduce the debt ratio. The government led by Giorgia Meloni faces intense pressure from European authorities to rein in deficits while simultaneously confronting domestic resistance to cuts in pensions, healthcare, and social spending. This leaves policymakers trapped between EU rules and political survival. Beyond France and Italy, a growing number of countries are under strain. Belgium has emerged as a surprising weak spot, with debt at roughly 105–108% of GDP and deficits of 4 to 5%. Chronic political fragmentation has repeatedly delayed fiscal reforms. Austria, traditionally cautious, now carries debt of 78–82% of GDP with deficits near 3 to 4%. Spain and Portugal have improved since the last crisis, but still hold debt ratios above 100%, leaving them vulnerable to shocks. Even the Netherlands has seen its deficit rise unexpectedly to 3 to 4%, undermining its reputation for fiscal discipline. The roots of this synchronized crisis stretch back several years. Pandemic-related spending in 2020–2021 added an estimated $2 to $3 trillion to European public debt as governments funded healthcare responses, business support, and furlough schemes. This was widely seen as necessary to prevent economic collapse. but it permanently raised debt levels. The subsequent energy crisis from 2022 to 2024 added another $350–500 billion as governments subsidized households and businesses to cushion the blow from surging energy prices and reduced Russian gas supplies. Germany alone spent more than $200 billion on energy relief, with France, Italy, and Spain contributing hundreds of billions more. Support for Ukraine since 2022 has imposed additional fiscal burdens. Military aid, humanitarian assistance, and economic support have cost Europe roughly $110 billion spread across multiple budgets and years, but still representing a significant unplanned expense. At the same time, defense spending has risen sharply as countries move toward NATO's 2% of GDP target. These increases, amounting to $50–80 billion annually across Europe, are largely permanent rather than temporary. Demographics add another layer of pressure. Europe's aging population means pension and healthcare costs are set to rise steadily through the coming decades. In many countries, these expenditures are projected to increase by 1–2% of GDP by the early 2030s, even without additional crises. Finally, the normalization of interest rates has transformed debt dynamics. Countries that once borrowed at near-zero rates now face refinancing costs of 3–5%. For highly indebted states, even modest increases in yields translate into tens of billions in additional annual costs, creating a vicious cycle of higher deficits and rising debt. Warnings are no longer confined to private discussions. French officials have publicly acknowledged that current deficit trajectories are unsustainable. Italian policymakers concede that without faster growth, debt dynamics remain dangerous. The European Commission has initiated excessive deficit procedures against multiple countries, formally signaling that fiscal rules are being breached. The ECB has repeatedly stressed that monetary policy cannot substitute for fiscal discipline, with President Christine Lagarde emphasizing that governments cannot rely indefinitely on central bank support. The International Monetary Fund has warned that European debt levels are likely to continue rising through the end of the decade under current policies. Credit rating agencies have followed suit with downgrades and negative outlooks. If conditions worsen, the crisis could unfold in familiar but dangerous stages. First, bond spreads could widen dramatically, reaching 300–500 basis points over German yields as in 2011–2012. At such levels, borrowing costs of 5–7% would be unsustainable for countries with high debt and low growth. Second, rollover risks would emerge as governments struggle to refinance the $1.5–2 trillion in debt that matures each year. Failed bond auctions or sharply higher yields would signal acute stress. Third, deposit flight could occur as savers move money from perceived riskier banking systems to safer jurisdictions, triggering liquidity crises. Political paralysis during such moments would amplify panic, while speculative attacks by investors could become self-fulfilling. Europe's ability to respond is limited. The ESM's $500 billion is insufficient for multiple large rescues. ECB interventions face legal and political constraints. Deep fiscal integration, such as Eurobonds or a centralized European budget, remains politically unacceptable to creditor countries. This leaves Europe facing an impossible trilemma. It cannot sustain current spending, avoid austerity, and refuse debt mutualization all at once. The most likely outcome over 2025–2027 is an uneasy compromise. Partial austerity will be implemented, provoking social and political backlash. The ECB will intervene enough to prevent immediate collapse, buying time rather than solving underlying problems. Structural issues will remain unresolved, setting the stage for future crises. This pattern of muddling through has defined Europe since 2010, but each iteration weakens institutions and erodes trust. With core countries now under strain, the stakes are higher than ever. Europe is entering a period that could prove more dangerous to the euro and the integration project than anything seen in the last decade. ChatGPT can make mistakes. Check important info.